Hello and welcome back, everybody, to the next episode of the Jerroms Miller Tax Hour podcast, a part of the Jerroms Miller Knowledge Hub. Today, we are talking about basis period reforms, which was introduced in Finance Act 22. Being basis period reforms and being a corporate tax advisor, this is not my subject. So I'm very pleased that I've got three guests with me today, all of which are very well versed on what we're talking about. So yeah, hopefully we'll have a good hour or so talking about base period reform, a few examples, what we're going to, what kind of we are encountering with clients and that kind of thing. So our first guest is Nichola Ross Martin. It's great to have Nichola back. We had Nichola a couple of episodes ago talking about HMRC information powers. So thank you very much for coming back, Nichola. Hope you enjoyed it last time and will enjoy it again. Nichola is founder of rossmartin.co.uk, which is a fantastic advisory website. Also runs the VTaxP for anybody out there needing advice, and is vice president of the CIOT. So thanks for coming back, Nichola, and yeah, hopefully we'll cover lots of stuff. And I know you've got some stuff on your website, and there should be some links in the description if anybody wants to have a look at Nichola's articles on this. Our next guest is Sam Mitcham, founder of SJCM Accountancy. This is the first time I've properly done anything with Sam, but I've known of Sam for ages on her LinkedIn, and I'm sure most of you, if you're on LinkedIn, you probably know who Sam is. Yeah, thanks for joining us, Sam. And yeah, I think your experience with the clients that obviously you help with this type of thing will be invaluable here. And finally, we've got Natalie, who's a tax advisor within the Jerroms Group. Natalie's been doing a lot of work for Jerroms clients on basis period reform as well. So yeah, we've got three people here that are very well versed on what we're talking about. So let's dive right in. The first thing is what are basis periods? I think that's the first thing we need to cover, because there's been quite a lot of talk about things changing, and so the real question is, what are they in the first place, and what does it mean? Nichola, you've done obviously quite a few articles on this, which are available on the website. In terms of basis periods, I think I learned this back when I was doing my CTA exams, and it wasn't the nicest thing to learn. Opening year rules, changing accounting periods, and all of this wasn't exactly the most fun thing to be trying to get your head around sometimes.
Well, yeah, I mean, under our current rules for self-assessment, sole traders and partners are taxed on the profits of their business in an accounting period, for an accounting period that ends in a tax year, and yeah, we're taxed on what's called the current year basis at the moment. We were taxed in a different basis many years ago, but that's all changed when self-assessment came in. I don't even know when it came in now. It was so long ago, but it was.
I think it was something like 96.
The change. 97 or something about, I think
96, 97.
Yeah. So so quite funnily, so us oldies, we've all seen this before because we've already done this several times. Well, because we did it when we had the change to the current year basis, and then we also, if we've acted for barristers, we had it all for that. For barristers, when barristers had the abolition of the cash basis, so that was quite an interesting thing. But I mean, yes. So I mean, the principle obviously is that if your accounting year is, let's say, you've got an accounting period ending 30th of April 2023, that falls into the 23-24 tax year. Well, that's how it would work in normal ways. But obviously, if you've got an accounting period that actually is coterminous with the tax year, so let's say you prepare your accounts to the 31st of March 2020, or say 2020, well, let's say 2023. If you do your accounts to 31st of March 2023, that falls into the 22-23 tax year. Whereas if you prepared your accounts to the 30th of April 2023, that falls into the 23-24 tax year. So so accounting periods are very important in terms of actually where our tax basis is and which tax year we're falling into. If that's
I remember doing some way back when. I remember doing some like partnership returns and things like that. And when partnerships having year ends of say June or something, it got quite complex when we're looking at, especially when it's partnerships and drawings and all of the rest of it. Actually getting the dates right and apportioning things correctly sometimes, because obviously if you've got a June year end, then you're possibly doing a tax return, and for some of the partnerships I was acting for, we were doing partnership tax returns in the January. So it's like 18 months old, and then you've got clients talking to you, and you've got clients talking to you about sort of the current year, and you're like, well, which year are you referring to? Are you the one I'm working on? Are you referring to the current year that you think you're in? And it became a bit of a nightmare on some of them. Sam, how many clients do you actually have that don't have a year end of the 31st of March, or do most of them have that anyway?
Yeah, most of them do have it anyway. So in percentage terms, we're less than, I think it's about 5% that have these obscure year ends. I think one of the reasons behind that is actually potentially the age of the clients that I'm dealing with. And I mean, in terms of how long they've been trading. I know when I first started out in accountancy, and there were quite a lot, like you say, especially partnerships, but there were also quite a lot of sole traders that would have April year ends, for example. And I think historically, I'm sure Nichola, and I'm sure you have more knowledge of this than me. I think historically there was an advantage to doing that because the time in effect that you pay your first tax bill was elongated, as simple as that. Yeah. So I kind of came into the accounting world knowing that, okay, well, there's some clients that have these obscure year ends, but actually there wasn't a clear reason as to why under the tax rules that I've always worked with. So I do think that, in terms of the percentage of client bases now that have these year ends that are partway through the tax year, the average practice, and certainly the practices that I've spoke to on this subject, will see that there's quite a low number. But I think the flip side to that is it does need thinking about, because the communication, and I'm sure we'll come on to this in a little while, but the communication that you do need to have with those few clients, be it only a few, is quite vast because it's a huge change for them.
Yeah. I mean, as I've almost ignored these changes as well, other than the fact that I'm corporate. So company, this doesn't apply to companies anyway. So that's nice. So it's actually doing a little bit of, research to kind of put this together for today. I've started to understand the transition rules. They're not, in a sense, to me, I'm wondering, is this not going to make things so much simpler going forward? I know that I know the existing, I know what we're talking about today, the transitional stuff.
Yeah.
But is there anything that's going to make it worse for any clients? Or is this actually just, this is part of making tax digital? It's going to simplify things. We're all aligned with the same tax year, accounting year.
Yeah, I was going to say, no, it's going to make it, the big problem you've got is if you've got, so let's say you're running a sort of, partnership, let's say a professional partnership or something, maybe a law firm or something like that. And you might have a year end, you're probably likely to have a year end sort of going towards December. And particularly if you're let's say you've got links to American, you've got divisions in America or something like that, then their tax year is on the calendar year. So often you'll get these practices and things that really want to retain a December year end for whatever reason. So obviously, and they don't want to change their year end just because they want to get to the 5th of April. Because obviously I think under making tax digital, it would be much easier if everybody has an accounting period of 5th of April. That probably makes a lot of sense. But there's a lot of reasons why you can't change your year end. And then, of course, so what it means is that you will always be preparing your accounts to the 31st of December each year going forwards. But then you're going to have to do a bit of chopping on each individual partner is going to have to then do a bit of a calculation and say, right, I'm going to have 9 months of the profit for the previous 1 year and add to 3 months of the profit of the next year. And that will then form my basis of assessment for this year. So so that's going to be that is a really complicated thing, you know. And it's not the same as some little sole trader who just goes, oh, actually, I did have the 30th of April year end. Actually, I can just do a quick catch up now and change my year end to the 5th of April.
It was things like solicitors who I were thinking about. Kind of, I can't imagine them changing so easily to just because the tax rules say this now.
I think. Sorry, from the advisory point of view as well, from a tax advisory point of view, you could be dealing with those firms of solicitors where you've got, you know, different partners in different positions in terms of one might be retiring, you know, and you might be talking with one about the spreading of the transitional taxes, for example, over 5 years. You might have one partner that's retiring in 2 years' time. So actually, from a tax advisory point of view, it becomes really like, you know, quite a task.
Yeah, I can imagine that. Yeah. I mean, when I was looking at kind of the time frames, you kind of think, Nichola, your example using December. Yeah. So if you've got a December year end, let's say we're in 24, 25, so we're kind of the ongoing rules, so not worrying about transitional for a moment. If you're doing the 25, 26 tax return, you need, as you said, the 9 months up to December 25 and the 3 months from the 1st of January to the 5th of April. But generally, you're not going to have, or quite often, you're not going to have done the accounts or finalise the accounts for that period, will you? Because it's only 3 months kind of ago, isn't it? So that seems like it's going to be a headache. Are people just going to have to be doing management accounts effectively, or is this just going to change kind of the mindset of actually we'll do our accounts very quickly after the year end?
Well, I think that I think unfortunately, these the bigger professional practices are going to have to rely on estimates. So what they're going to have to do is they're going to have to basically sort of take a filing position. They're going to have to say, right, our accounts for this period aren't fully ready yet. But obviously, the best thing, the good thing about the bigger practices is obviously they've got really good functioning accounting, or useful accounting functions. So actually, they're not too bad at making, giving you some management accounts, as it were. But somebody's still got to say, okay, yes, well, let's take a filing position on these, and then let's all file our returns. Obviously, and not most. I mean, it depends on the practice, but not all partners will actually be having their returns done by the same advisors, which is another issue. And then you've obviously got to look at that, and then you've got to wait till the actual accounts come in from the practice, the finalised versions. Then you have to go back, compare your return, and then adjust your return. Obviously, you've got your 1 year after your filing deadline to adjust your return. And obviously, you can also at that time then make a decision about whether you want to adjust your transition profits at that time as well. So because obviously under the whole, I mean, sort of going back a bit, we're jumping around, aren't we, a bit, I suppose, here. So under the idea of this, so basically in 23-24, we will calculate, you'll calculate your normal profits for the year, and then we'll work out your year end to the 5th of April 24, and then that'll be your transition period. You can deduct your overlap relief from that. You can deduct any brought forward losses and make other adjustments, and then you can then spread that over 5 years. And that spreading, you can accelerate it or change it by making a different election. So basically, you've got 5 years of elections to think about as well. So
I think it's simpler, isn't it? If there's consistent profits, that they're similar profits each year, really, that would make the whole process simpler. It's more,
But if you suddenly making a loss, or like you said, if you cease trading,
that's when things are going to get more complex.
Yeah, we had one the other day of somebody who was asking what happens when a sole trader converts into a partnership. Is that classed as a cessation? So we had a little bit of a worry about the rules there.
Corporation, isn't it? Well?
Yeah, there's going to be all sorts of strange things, and then obviously you've got things like where you've got a partnership that then wants to incorporate. Yes. What happens then? You get some partners might have a bit of a shock. But I mean, some partners might be elected to have all their to have all their transition taxed in year one, sort of effectively, so they won't care. It will depend on. Well, I mean, it will depend on personal circumstances, won't it? So let's say you've taken out a load of invested in a lot of sort of, I don't know, SCIS, EIS companies. You're making big pension contributions or something like that. That will really affect when you want to mop up your transition profits. So I think with these, certainly wealthier individuals of these professional practices are going to have a bit of a juggling act for the next 5 years. And then thereafter, they're going to have a continual problem because they're always going to be struggling to get their tax return completed because of when their year ended. So
so just going back to something you said a moment ago, in terms of if they've got a certain year end and they haven't finalised the accounts, then they're going to have to go back and make the adjustments if they've used estimates. Is that the only way we can do it? It's just go back and file an amended tax return, or is there some? I mean, to me, it would make more sense to say, okay, you've estimated these, and then in the next tax year, you can have some sort of catch up if you've got a 5,000 extra profit or something based on your estimates. You kind of think, well, why do we have to go back and do an amended return? You're having to do an extra tax return in effect, aren't you?
Yeah.
Is that just this is how it's going to work?
Yes, this is how it is going to work, because also the other horror in this, of course, is that the self-employed all make payments on account.
That was one of the other things I was thinking. I was like, by that point, my mind was blown, so I just gave up.
And this is from my point of view. As you know, I work with a lot of small business owners, and with all due respect to them, it's really difficult to explain payments on account at the best of times.
Normally,
never mind payments on account with transitional periods and spreading of this extra tax bill, because that's what they're going to see it as. And I think I just keep coming back to this communication piece where it's going to be really difficult to explain. Not only have you got payments on account, but you've got transitional periods to think about. You've got the spreading of taxes to think about, and then we've got to take into account different partners that might have different financial circumstances. It is it's opening a can of worms, so to speak, with these small businesses, and it's going to be very, very hard to kind of keep
more
them.
work for us, isn't it, as advisors?
Absolutely more work, and also and it's the cash flow planning for these business owners as well, for sole traders and for individuals that they could be quite used to having static payments on account, a slight increase here and there, slight dip. For every 6-month payment will be roughly the same if they've been, and then to kind of come in and say, not only do we want to start talking to you about the option of changing your year end here, but also, by the way, you're going to have this extra bit of tax, and then trying to communicate overlap relief with them. It's just it's going to be a difficult time.
I mean, the other thing as well is obviously this is creating more work for us, which it's not great, given that it's the client is operating their business in exactly the same way. So to them, there's not much, their day-to-day isn't changing, but the tax rules are. But doesn't that mean that all of this is going to cost the client more to actually kind of have these discussions, have longer meetings to explain all of this? And, it's not just the tax costs potentially being accelerated or whenever they fall, but, it's potentially a real cost to them as well.
Yeah, which is always difficult, again, because, it's very hard for us to sit there and say, well, this isn't something this isn't our fault. This is HMRC saying that this has to be done, right? So it is similar to the conversations that I'd started having about making tax digital, because I was quite forward thinking with that, and trying my best to start having those conversations with clients. One point about making tax digital is that actually there's extra work to be done, therefore your fees are going to increase. And clients automatically, in my experience, see that as something that I've chose. I'm trying to offer them extra services, and it is quite hard to work with small business owners and get them to understand that all we're doing is following HMRC legislation here, but it subsequently creates more work for us. They don't like that, because it almost does sound like a fob off from our part, trying to oversell services. And that's the reality, especially when you're dealing with small business owners, especially when you are fundamentally having to tell them that there's going to be extra taxable profits. So it's a bit of a catch-22, actually.
It is. Yeah. You reminded me of, when did they announce Making Tax Digital? It was meant to be in about 3 years ago, and we're hardly starting it. But 10 years ago or something like that.
Yeah,
but I remember
it must be 2014, I think. Yeah, something like that.
I was thinking 14. Yeah, but I remember the budget. Sorry. I was having discussions with my the tax partner at the time, and I was like, but if they're essentially saying we're getting rid of all self-assessment, is this going to kind of mean, personal tax advisors, their work is either going to go down or at least change to more of an advisory role? Whereas now we're actually we've got loads more to do. It's kind of the opposite, isn't it? It's not making anything easier so far, but I mean, that's a whole nother topic for
we did always joke that MTD stood for making tax difficult.
Yeah.
But I mean, I think probably the way forward is to have just have everybody on a standing order, as if a bit like a Sky subscription. So you just pay your subscription to HMRC. It's calculated at the end of the year or something, because it's all about cash flow, isn't it?
Yeah.
So it's all about the government wanting to get in this money sooner, and obviously the way they can get the money in sooner is by making sure that our profits are all taxed effectively in real time. So a bit like we've got under the PAYE system, where your employer reports PAYE before you're paid. So the figures go in, and obviously this is the big problem with self-assessment, this time lag. And obviously they have to do basis year reform, because actually Making Tax Digital won't work otherwise. Yeah. Because we need to be reporting things on a tax year basis. Otherwise, it's too difficult for the computers, basically. So it's sort of pushing everything back onto the taxpayer. So it really saying to the taxpayer, if you fit into the tax year, it's much easier. If you don't fit in with the tax year, and you're like a law firm with a 31st of October or 31st of December year end, then unfortunately it will be difficult, but it's not the state's fault, effectively, it's yours.
Yeah. Oh dear, fun and games. I generally don't use slides for podcasts, because the whole point is, although we're recording and it's going to be available on YouTube, or there's also available on Spotify. So, but the topic we're talking about, I struggled in preparing to think, how on earth can we do all of this without some numbers? So hopefully, if we talk slow enough, people who are just listening to the audio might be able to follow through. I just thought I'd start off with an example of kind of the ongoing rules, because that's kind of, in a sense, the easy bit. So I've just got a very basic example. We already talked about December year end. So if we take an example of, we've got a December 24 year end, they've made 50,000 profits. And we've got a December 25 year end, they've made 100,000 profits. So if we're calculating the 24-25 tax liability, we need 9 months to December 24. So 50,000 times 9 over 12, 37,500. And then we need 3 months from the 1st of January to the end of March or 5th of April. So 100,000 times 3 over 12, 25. So 37.5 plus 25, 62,500. So that's how it's going to work going forward, which is reasonably straightforward, if not perhaps practically difficult with having to use estimates and things like that. Now, what I did have a little play with, and I thought I'd share it on this podcast and see if we can break it, but I tried to make a calculator for this. Mm-hmm. So let me switch screens. I made a little calculator. The idea is, you put your year end in, you say what your profits are, and it'll tell you what your profits and your averaging and all the rest of it. So if we do a couple of examples and see if we can break it, and if you can't break it, then people are welcome to email me and ask me for a copy of the calculator. But
have you tried it against HMRC's one?
I haven't yet tried it against HMRC's one, so let's see what happens.
We need to.
This is where I'm really on the chopping block, aren't I now? Okay, so we've talked about going forward. We've just got a split between tax years. One thing we haven't talked about is we're talking about splitting between tax years. I generally always just go 31st of March, and we've talked about sort of 5th of April stuff. I am right. We can just go with 31st of March if we want to keep our lives a bit more straightforward. So we can kind of say 31st of March can be treated in the same way as if it was the 5th of April.
It's deemed to be the 5th of April. So anywhere between the 31st of March and the 5th of April is now the 5th of April. So, but it's much easier to do.
I was going to say, we can just say we can just calculate on months now, can't we? In reality, unless someone's got a really funky year end in the middle of the month. The calculations are done on days. I think strictly it's a day's thing, isn't it?
Yes, which just makes it slightly more confusing. So I mean, really, if you want a simple life, you just have it to the 5th of April, I think. I have to be impressed. I've done that with all my clients.
Have you? Okay.
Yeah, I think I have got a couple of 31st of Marches, but mainly 5th of April's. Yeah.
Yeah, same. I always do 5th of April as well. I think the ones that are 31st of March, we do have half a dozen, but they've been kind of inherited like that. You know, I've taken them from a different accountant with that, and I haven't, you know, it's not worth changing. However, I do wonder, again, coming back to MTD, I do wonder if I'm going to be complicating something there, because obviously then we'll be working to 3 month points when we're doing quarterly submissions. So then do we really want to be running it to the 5th instead of the end of a month? I don't know. I do sometimes wonder. And another time that I've wondered whether it would be better to stick to 31st of March is when I have VAT registered sole trade businesses, because otherwise, obviously, you know, you've just got that little gap. And I just think, year ends the 5th of April, but the cut off for the VAT's 31st of March. You know, it's one of those, but thankfully they're not complicating that 5 days in basis period reform.
Yeah, didn't we have this? I can't remember where it got to, but I'm sure there was at one point a proposal to change the tax year end to the 31st of March or something like it. Well, there was, because the 5th of April, doesn't that come from kind of old rent periods or something historically? Yeah. So we've got this weird tax year end date because of the old rent periods. And so that to me, it made sense, although it did sound like it might be a bit more hassle than perhaps it was worth. But just to say, well, we're going to have a tax year. I'm sure at one point there was a proposal, should we do it for the 31st of December? Was this a consultation possibly?
Yes, that's right.
Yeah,
it was. Yeah.
So either do a calendar year or at least the 31st of March, but nothing seems to, I don't know whether there was any conclusion to that consultation or whether it's still under consideration.
No. I think they decided it's gone into the too difficult drawer because we've got PAYE that obviously runs to the 5th of the month as well, and so there's just vast amounts of changes to be made. I mean, really, really complicated changes, encoding and all sorts of things. And I think a lot of software people and everyone just said, look, can we just leave it as it is?
I do actually know you said the software thing. I do remember there've been quite a lot of shouting about that bit. So.
Yeah, it's too funny, isn't it? Because most of us wouldn't mind it, you know, but actually practically it's becomes so difficult when all our systems are running to so many, you know, are running in this way, you know. And you think about all the employment agencies everywhere, everyone is driven to these certain dates, so it's very hard to change en masse.
Yeah, and I think
would be possible.
Well, it is what it is, and if it's gone into the too difficult drawer, which I like that term, I'm going to copy.
I like that. Yeah, that's really good.
There's a better place as well, but I'll tell you about that afterwards.
Okay, so as I said, actually, sort of before the start of this week, I'd really not paid much attention to basis period reform because I don't really get involved in it from an advisory perspective. But it seems to me that there is a process. It's somewhere in Finance Act 22, isn't it? I think it's paragraph 70 of Schedule 1, if anybody wants to look at legislation, which actually sets out the steps. So in a sense, it's kind of a mechanical thing, which I think is why when I looked at it, I thought, surely you could have a calculator for this and it wouldn't be too difficult. So, so the first step, and you guys have probably done an awful lot more practical work on this than me, but the first step is just looking at the standard period, isn't it? Which is basically to say we've got as before, we had a year end that falls within the tax year, so we need to tax those profits. The next step, I'm trying to do this off the top of my head, and I've done, as I say, you guys have done loads more than me. So the next step is then to figure out what's this transitional period that we keep talking about. So if we take June, we've got a year end in 23-24, because that's our transitional tax year. 23-24 year end, June 2023. So we've actually only taxed of that year, April, May, and June, so 3 months. We now need to tax from the 1st of July to the 5th of April, 24. So we've got another 9 months and 5 days to tax, which is why we're talking about this. There's big implications on cash flow and things like that. So we've got a standard period, we've got a transitional period, then we can make a few adjustments to that transitional period, and then we can figure out what we tax. Have I summarised that okay?
You have, yeah. Oh, that was good.
Yeah.
So, sorry, I'm working on a different screen, which, when you're working on a massive screen and the mouse goes really slow. So excuse me if I'm doing something stupid. So if I'm playing around with my calculator, we've got 30th of June, 23 year end. You'll see all the numbers change now. So if we take an example, so 30th of June 22, we make profits of £80,000. That's normal. 30th of June is 22 is in the old rules, the current year rules, it's before the 23-24 tax year. So that's fine. We then have 30th of June 23, and let's say we make 120,000 profits in that. And that's, as I said, that's the standard period for the 23-24. Let's then assume we make 70,000 in the following year to June 24 and 90,000 to June 25. And then we've got £19,000 worth of overlap profits. We haven't really gone into the existing rules in terms of how you worked out things under the now old rules. But basically overlap profits were when you started to trade and you had similar rules where you had to you initially taxed to the first tax year, then you tax your year end. So you could have an overlap of periods which you taxed twice.
Nice, yeah.
And what that means is you then basically you suffer that. And I think this is why when I was doing personal tax years ago, most people were kind of like, I don't want to do that, so I'll just have a year end of March kind of thing. So, if people were very profitable in the first year, which obviously a lot of businesses aren't necessarily, then that actually almost convinced them that a March year end was preferable. So basically, because we've taxed profits twice previously, we can finally get relief for them. Normally, if we weren't doing this, you wouldn't get relief until either you change your year end or you cease to trade. So now the reason I say let's see if we can break it is because I've just put that information into this spreadsheet, and hopefully that's our answer. So the standard period, so we've got 12 months to the 30th of June 23, we made £120,000. So that's step one of our calculation. Step two, we figure out what our transitional period is, which is from the 1st of July 23 to the 5th of April 24. And then we need to apportion the profits because we've got a year end of the 30th of June 24. I've just kept this on years rather than on days for the time being for these examples. But we made 70,000 in the period in that year. We need 9 over 12 of that. So a transitional period profit is 52,000. So So that's step 2. We've got step 1, standard period, 120,000. Step 2, transitional period, which is the actual days in that gap, effectively, 52,500. And then we can deduct from that 52,500 our overlap profits. So that takes us down to 33,500. Now, the problem we've got is we're taxing 120,000. In theory, we are then wanting to tax this additional profit of 33,500. So as we've said, if we didn't have any kind of ability to average this out, we've gone from, we would have had to pay tax on 120,000 profit. Now we've got to pay tax on 172,500 in one tax. It's a massive hit. As we said, payment on account, that's going to increase as well. So it's going to be pretty horrible. So what we then say is, okay, we can average that over 5 years. If we take our the answer to step 3, which was 33,500, divide that by 5, we can tax, instead of 33,500 for 23-24, we do it over 5 years. So we take 120 plus 6,700. So our taxable profit has become 126,700. That's a lot of numbers to talk about. Hopefully that makes sense. I think the averaging part, I mean, in that example, that's not too painful, is it? Because actually the 120,000 for the year ended in the 23-24 tax year, it is a big profit, and then they've reduced in profit. Whereas if you switched it round, so let me just play around with the numbers a little bit. Let's say we had £50,000 worth of profit in our June 23, so we're expecting to pay, or had we carried on as normal with no change, we'd be paying tax on 50,000. But let's say it went from 50,000 and then the next year went up to 100,000. We're now averaging 11,200 over the year, over 5 years, so we've 61,200. So, you know, that effectively what we're saying is we've taken 50,000 profit, basic rate, and now we're into higher rate taxpayers. And also, presumably, this will affect anybody on a high income child benefit charge. So
it doesn't affect the high income child benefit charge.
No.
Okay.
They've said that
standard.
That's good, because I was thinking, wow, this is really becoming painful.
Yeah.
Okay.
No.
Yeah. So
I think is it the adjusted net income figure? Is that the figure that they've said it won't be impacted by this spreading thing?
Yeah.
So that was good news, because there's other things that impacts, right? Like sorry, it's not called child maintenance anymore, is it? But you know, there's that kind of thing as well, and obviously we've got mortgage applications, we've got, you know, there's all sorts of things that look at that figure. So I think that was quite an important fact, actually. Once I came across the legislation of that, I thought, right, that's okay.
Yeah. Great.
So in that case, has anyone got this on their software yet? How do we actually sort of do the standard self-assessment comp? Do the averaging profits go somewhere they don't go in, or do they still go in kind of the top?
They're not called averaging profits, because if we call them averaging profits, then we get very confusing. It's very confusing because of farming and market gardening.
Oh, good point.
There's all the averaging for that. So I think we just call them transition profits or something. You know,
transitional profits. Yeah. Good point.
I think
to be fair, I was getting confused.
When I saw your calculation, Nick, I was thinking, oh my God, you're adding averaging as well. And I was thinking,
you were thinking, what a good spreadsheet this is if he can average it as well.
Yeah, I think they're on the tax comps I did a bit of consultancy work with one of the software providers, and it looked to me like it was going to be a below the line calculation is what I'd call it, you know, so you've got like your bit up here, which is your normal bit, and then literally, you know, kind of like the mortgage finance relief, you know, how it's kind of down here. It looks like that. I'm yet to actually see final. But that said, it must be out there now, because you know, they must have that ready now, so we'll soon see exactly how it looks on tax comps, I guess. I'm assuming at this point, sort of the Jerroms group haven't had an update for their to their software, but
we have,
I can imagine this was Oh, we've had it on. Oh,
yeah,
excellent.
yeah. So we've had it only this week though. So I'm yet to actually do a client.
I was going to say, have we tested it yet?
I've yet to actually do anybody's, but I've had a play with it, and it's not too bad.
Okay.
Yeah,
that's good. I was going to say, if anyone has any sort of specific questions, I should have said this at the start. Please do sort of put a comment in the chat. If you've got any examples you want us to try and work through, we can have a play. But obviously, any questions coming out of this afterwards, always email. Or if you do want a copy of anything, then you've got our details. Should we have a play with another example? I'm trying to think what other example should we do? Should we do a September year end?
I was going to mention one thing, which is this whole business of overlap profits.
Yes.
So there was a big thing initially of people saying, well, we haven't been recording our overlap profits. We don't know what they are. We can't remember what our account said.
Yeah.
And HMRC though have now made a facility so that you can actually go onto HMRC and you can ask HMRC for your overlap profits.
And it works quite well. We've done it here as a backup anyway, but it's a relatively simple form, and the response time was good as well in getting those figures back.
So is this just a form that you kind of submit electronically to them, and
find out the overlap that they hold for those clients?
They were saying we'll dig out the link to that and include that in the description.
I was just going to add, I was going to say the ICAW said this week that there's quite a lot of demand for it apparently. So there obviously are people out there with overlap profits that we obviously that we haven't got hold of yet. So there's quite a few unrepresented taxpayers in this, and obviously HMRC's made a lot of material on this, including HMRC's got a calculator on it, but it's you've got to actually kind of know what you're doing to know what the right bits are. Otherwise it can be quite confusing. I was trying to use the calculator actually, Nick, while you were talking, and I found I couldn't actually use HMRC's calculator and listen at the same time. So I'm not very good at multitasking. I think your calculator is a great idea, though. That's fantastic, because then you can just look at it and just go, wow, that's how it all works like that.
Yeah, it's good.
Yeah, I think that's the idea. That's, to be honest, that's just how my brain works. I'm like, a nice calculator, I'll take it. I've got, we've built them for salary, visits, dividends, all of these types of things, and I do like a nice calculator. But I think this is very mechanical, isn't it? So I think it makes sense to have something like this. The only problem is there will be some random scenario somewhere that you think, actually, this doesn't cover that. That's always the problem with calculators. You have you have to kind of give it the common sense approach as well, don't you? So
it does make it easier. Sorry, I was just going to say, sat with clients, it makes it easier sometimes as well to have these kind of things in front of you so that they can actually see the numbers, how it formulates through, because you can't just throw a tax comp at a client and say, because the computer says so, right? They want to know why. So, and things like this, I always find it's, it is useful for that.
Yeah.
Yeah. I mean, I've even had, sorry, Karen, Nichola.
No. Sorry. Well, I was going to say it's also just then the juggling the payments on account as well. This is where it becomes super complicated, because obviously it's much easier to use our tax return software for calculating payments on account, because it's got all the data. But the problem that you've got is when we make these sort of calculators and they don't actually then go, the figures don't go through. So it's annoying. What we really want is our tax software to have these calculators as a function with it as well.
Good,
because then the software's got the data, but got all the data, it would make life easier. But,
I mean, but I always say way back when I did the personal tax returns, because it does feel like another lifetime ago now. But we used to basically have a manual. We do a tax return, and then we do a manual computation to make sure we were happy with what the software came out with. And there were times you looked at it and you thought, why is the software coming out with that answer? Sometimes the software had actually there was some weird and wonderful rule that you were like,
Yeah.
okay, good point.
Yeah.
But other times there were things in the software that, you know, the formula wasn't quite right in the software. So, you know, it's always worth sort of
Double check.
as I say, giving it that common sense double check.
We do that. So the beginning of, you know, every tax year, we kind of create a new spreadsheet that's in effect duplicating what the software is doing, but at least we can then drill into the formula. You know, it's as simple as that. I mean, sad to admit, I quite enjoy devising that, putting that spreadsheet together as well, but there you have it. Like you said, then it's a challenge for somebody to break it.
Yeah, that's the thing. And I'm sure, as I say, I literally put this together yesterday, so it may or may not be suitable, but it's got some funky formulas in there too. Sorry, I'm getting into a real Excel geek now as well as a tax geek. Okay, so we've kind of talked about a couple of examples, and yeah, I mean, we could go through loads of examples, but we haven't got all day. And yeah, anybody who wants to reach out and either have the calculator, use HMRC's calculator or whatever, just feel free. What about businesses starting in 23-24? So we've talked about loads about the sort of the ongoing businesses and what they're doing with transitional, their payments on account, things like that. If you start in 23-24, as far as I'm aware, you're just straight into these new rules. That's the end of it. Whatever year end you want to pick, there's no in effect transitional period, because you're just going to tax to the end of the tax year from when you start.
But I doubt that anybody's going to allow any sole traders to start with any other year end now.
Yeah,
if there's an advisor involved, we're going to force them as much as we can.
Yeah. As I say, unless they've got a really good reason. Like, to be fair, I used to advise people that just because I was like, look, it's a lot simpler anyway in terms of your planning and things.
Yeah.
And I was doing that 10 years ago, so I can imagine everybody doing it now.
We've got a couple of clients that have the wrong VAT stagger for their year end, which you know, so they've got 31st of March year ends, but their VAT stagger is the 28th of Feb, 31st of May stagger, and we thought long and hard about changing them, but we like having different dates, so it's actually, we don't really want everybody to have the same year ends. So because actually it brings it all to a head. Yeah. Okay, it's actually how we're timing our work.
Yeah,
I was going to say, yeah, you're quite right, actually. Yeah, we're just going to all be doing the same work. It will become massively seasonal, won't we then? Yeah. We don't want that.
Yeah. Yeah, well,
yeah, it's all.
I mean, anyone in person. Yeah. Sorry. Yeah, I was saying anyone in personal tax is seasonal anyway. So.
Yeah, I was going to say that was the best thing when I moved to corporate tax. I was like,
yeah,
I've got Christmas off. What?
We love January.
Okay, so that's businesses starting. They're just straight into these rules. Businesses ceasing. I believe they're just staying. They don't need to worry about any of this. It's just that you were under the old rules. There's no point changing. You do your cessation and use your overlap profits as you would have done, and that's that for you. So yeah, starting and ceasing. I think you kind of. I guess if you're starting, and you've not done tax returns before, you don't know any difference, and maybe this doesn't seem such a big thing to you, maybe.
Yeah.
I think there's something about terminal loss relief, isn't there? So if the loss arises in the transitional year, then you can
get the additional
treat
relief
it as if it's
transitional the 3 years.
Treat it as if it's So that's quite an interesting part as well. It took me a while to kind of get my head around. I look forward to explaining that to a client. I think tricky.
That's going to be a good one.
Yeah. So we've lost it. So we've talked loads about profit and how this is going to affect in a couple of examples. So with a loss, what we're saying is if you've got a loss in the 23-24, isn't it just the transitional period that you get the terminal loss on?
That's right.
If you've got a loss in your standard, So if we use June again,
That's
if you've got,
conventional then, yeah.
Yeah, June 23, you make a loss. You can just basically current year against all income or carry it forward, can't you?
Yeah, the conventional, yeah.
And then the transitional period, as you say, Sam, if you've got a loss, so something about overlap profits as well. I think it's after you've deducted your overlap profits, then you can use
That's
that
the
as a
reason it
term.
causes it, yeah.
That's as I say, kind of on the face of it, you can kind of say this is a mechanical process, go through this and you've got your answer. But as you say, Sam, actually trying to explain this stuff to clients is going to be
it's really going to be a case by case basis for each individual client, different for each of them.
Yeah, definitely. Sorry, I was just going to say, I considered putting something out in terms of a video, to help those clients. But when I started looking at it, I thought that it's not going to apply the same to every client. So it was really almost impossible for me to put a video out on social about it. So I just left it alone.
Yeah, it's almost like, can you kind of put like 5 or 6 case studies together and say these are some common examples kind of thing? But that's about as far as you can go, isn't it? Yeah. Have we talked about disapplying the averaging? Sorry, Nicola's going to shout at me in a minute. Keep calling it averaging. Have we talked about disapplying the transitional profits spreading? Well, I don't know, whatever you want to call it.
You can elect to do that if you want to. I think the thing to do, you've just got to look at what your business is doing over the 5 years where the spreading applies, and then so if you've made a loss. If you're making a loss in, I don't know, 24, 25 or 25, 26, you might want to accelerate.
How much do you use?
So you can make an election and just say, right, I'm going to use up, I'm going to offset all my remaining transitional profits, my next 2 years of transitional profits against this year of loss.
There's certainly going to be more opportunities for tax planning, isn't there, here?
Yeah. Well, I think also a lot of things of people, should be making decisions about, okay, is it actually time to really look at when I'm making timing of pension contributions? So you need a bit of a crystal ball really as well to be sort of trying to guess what your business is going to be doing over the next 5 years. Obviously, and it's also down to cash flow as well, isn't it? And then going, right, okay, and would it be opportune really to actually use up maybe some unused pension inputs, make a big contribution with that. Also, what are we doing with tax rates? Do we think tax might be cheaper? Is it better to not try and accelerate anything away because in the hope that tax rates will go down? So.
Oh, there's so much to think about.
It's awful, yeah. That's why it's quite difficult to build a model for it.
I think what's become clear to me, at least, is A, thank God I'm not having to deal with it. B, and B, there's just loads of. It's almost like a separate exercise. Okay, well, for a client, we'll do your tax return this year, but also as a bolt-on, maybe we should have like a separate thing of. Well, let's look at some forecasting and let's do X, Y, Z, as you say, to look at payments on account, pension contributions, all of these types of things to actually, make sure things are falling. But as I say, because I'm not that heavily involved, the child benefit thing kind of rang alarm bells for me to start with, thinking, oh, can you imagine all of that? So at least they're safe from that kind of thing.
Yeah.
Good. I think, has anyone got any other sort of practical issues? I was going to draw it to a bit of a close, but unless anyone's kind of come up with anything else kind of during the day-to-day.
I was just going to say, because this is one area that I haven't looked at all. Obviously, there is this cap on income tax release, and I've got no idea how that cap interacts with this, or whether this will be an issue for anybody. But I was just thinking, when you've got a situation of a sole trader with a vast capital allowance claim, so that's when this sort of the cap can apply, and I don't know if there's any way for somehow losing the effects of the cap by being able to mop up transition profits in that situation. So I don't know whether a large capital allowances claim might actually make a material difference. But unfortunately I don't have any clients that would fit that bill. And that's, you know, maybe it's sort of a bit academic, but you occasionally meet people.
Possibly, but I bet there'll be an example somewhere of it.
It's probably in a CIOT exam paper.
Yeah.
Right. I've got one of those next week.
Have you? Oh,
Yeah.
gosh, best of luck.
Thank you, I need it.
I'm sure you don't. No, there's actually, you've mentioned that. There's for anybody wanting to do more reading and see more examples, there's Taxation magazine had a 2-part on basis period reform, I think last week and the week before. So that was quite a good article from one of the tutors. I'm not sure from which firm, but so yeah, go and have a look at that as well. That's quite handy. So we'll try and include some more links in the description. So we definitely want a link for HMRC's calculator. If anyone wants to play around with mine, feel free to email me and I'll send that across. And what was the other one I was just talking about? Well, we'll add as much as we can, so you've got as much information as you
It was the link to get your overlap profit.
Yes, yeah, we need
Good
that.
one.
Yeah, okay.
Yeah.
Well, hopefully that has been useful for people, and all that remains is to thank Nichola, Natalie, and Sam for joining me, and hopefully you've enjoyed it. And yeah, I think it's an interesting space and a lot of work to come for us as advisors. So thanks for joining us. Anybody on Spotify, YouTube, subscribe, like, do all of that stuff so that you get notified, and hopefully we'll see you again in a month or so's time.